Applying for a personal loan can feel overwhelming, but going in with the right knowledge can save you money and stress. Before you sign on the dotted line, it's crucial to prepare a personal loan checklist, essentially a set of questions to ask before applying for a loan. In this video, we'll guide you through everything you need to know before getting a personal loan, including real-world borrower scenarios, comparisons between lenders, key loan eligibility criteria, and common mistakes to avoid. By the end, you'll have a clear loan application checklist and know exactly what to ask and look out for before you apply. Let's dive in. The first question to ask yourself is why you need the personal loan. Is it for an emergency medical bill, home improvement, debt consolidation, or a discretionary purchase like a vacation? Personal loans are versatile and can be used for many purposes, but that doesn't mean every purpose is wise. For example, using a loan to consolidate high-interest credit card debt or cover an essential home repair can be smart. On the other hand, financing a luxury vacation or shopping spree with a personal loan is generally a mistake. You'll be paying interest on expenses that don't generate lasting value. Consider whether the expense is a need or a want. If it's something you could save up for or maybe forego, reconsider taking on debt. Real-world scenario. Emily, for instance, thought about borrowing $5,000 for a high-end vacation. After some thought, she realized she'd be paying interest on that trip for years, long after her tan faded. Instead, she decided to save monthly for the vacation. Bottom line, only take a personal loan for a good reason, ideally for essential or productive expenses, like consolidating debt, a necessary purchase, or an emergency, not for impulse wants. Also, check if a personal loan is the best type of financing for your need. For example, if you need funds for a very short term and can repay in a couple of months, a 0% promotional credit card might be a better option than a loan. Or if you're making a home improvement and you're a homeowner, a home equity loan or line of credit could offer lower rates. Always match the tool to the job. Before applying, determine the exact amount you actually need to borrow, and try not to borrow a penny more. It's tempting to take a higher loan amount if a lender approves you for more. But remember, every dollar you borrow will cost you interest. Taking more money, just in case, or because it's offered, will only increase your debt and interest payments. Instead, base your loan amount on a specific purpose or budget. If you're consolidating debt, add up your existing balances precisely and maybe include a small buffer for any origination fees. If you're funding a project, get quotes or estimates so you know the cost. Real-world scenario. Carlos wanted to renovate his kitchen and figured roughly $10,000 would do. Before applying, he got contractor estimates that came to $12,000. He borrowed $12,000, not $15,000 or $20,000, to cover the project. He avoided the mistake of borrowing extra just because he qualified for more. Some lenders might approve you for, say, $25,000 when you only need $15,000. It's up to you to resist taking the full amount. Borrowing more than needed not only means higher monthly payments, but also more interest paid over time. Keep your loan principal as low as possible while still covering your needs. One of the most important questions on your checklist is whether you can comfortably afford the monthly payment that comes with the loan. Look at your budget and current obligations. A common rule of thumb is to ensure that no more than roughly 36% of your monthly income goes toward debt payments. This is known as your debt-to-income ratio. If taking this loan would push you well above that threshold, it might strain your finances and put you at risk of default. Lenders also use your debt-to-income (DTI) ratio to judge your ability to repay. The lower your DTI, the less risky you appear. Calculate what the monthly payment will be for the amount and term you're considering. If you haven't picked a specific loan yet, you can use online calculators to estimate this. Then, honestly assess your budget. After covering all essentials, rent, mortgage, utilities, groceries, existing debts, etc., will you be able to pay that loan bill every month? Don't forget to leave room for savings and emergencies. If the new payment seems like a stretch, consider borrowing less or choosing a longer loan term, though longer terms mean more total interest, which we'll discuss later. Real-world scenario. Ava is considering a $300 per month loan payment. She looks at her finances and sees she has about $500 of wiggle room each month. A $300 payment would use a big chunk of that. She decides to cut a few discretionary expenses to comfortably accommodate the loan, and only then does she proceed. The worst case is to take on a payment you can't sustain, leading to missed payments that trash your credit and financial peace. Always ensure you have a clear repayment plan for the full loan term. In summary, stress test your budget. If money is tight, you might opt for a smaller loan or a longer term to reduce the payment, or work on increasing income or cutting expenses first. Never assume, "I'll figure out payments later." Plan for them now. Before you apply, check your credit score and credit report. Your credit score is a critical factor in whether you'll be approved and what interest rate you'll get. In fact, your credit score influences everything about a personal loan offer: the rate, the term, and whether you'll even qualify at all. Generally, the higher your score, the better. Higher scores not only improve your chances of approval, but often secure you much lower interest rates. Lenders have minimum credit score requirements that vary, but a good to excellent score will give you far more options and cheaper loans. If you haven't already, obtain a free copy of your credit report and score. Look for any errors or issues on your report that you can fix before applying, such as disputing mistakes or paying down outstanding debts. Even a moderate improvement in your score can make a big difference. For example, raising your score by 50 to 100 points could be the difference between getting a loan at, say, 12% APR versus 18% APR, which is serious money saved on interest for a $10,000 loan. Also, understand that applying for a loan will typically result in a hard inquiry on your credit, which can ding your score slightly. That's normal, but you want to avoid unnecessary multiple inquiries. We'll talk soon about how to shop around wisely. The key is to go into the application with your credit in the best shape possible. As one expert put it, walking into a loan application without knowing your credit is like showing up to a job interview without researching the company. It puts you at a disadvantage. So, check your credit and take time to improve it if needed. Even waiting a few months to bump up your score can pay off. Beyond credit score, ask, do I meet the typical requirements for a personal loan? Each lender has its own criteria. Common eligibility factors include your income, employment history, and debt-to-income ratio, in addition to credit. Lenders want to see that you have a steady source of income to repay the loan. Some may have a minimum income threshold or require proof of employment. Others might consider additional factors like your education or banking history, but those are usually secondary to the big three: credit, income, and existing debt load. Research or ask about a lender's basic requirements before you apply. Many lenders, especially banks and credit unions, will list general qualifications on their website. For example, they might say, minimum credit score 660, or at least 2 years of credit history, or minimum $25,000 annual income. If you fall well short of a lender's requirements, it may not be worth applying there. Instead, look for a lender that fits your profile. Some specialize in loans for fair credit, for instance, while others cater to excellent credit borrowers. Also consider if you have a cosigner option. If your own qualifications are a bit weak, some lenders allow cosigners, which means a friend or family member with stronger credit income can cosign the loan to help you get approved, though they would be equally responsible for repayment. Only pursue this if both parties are clear on the risks. Real-world tip. Many lenders let you pre-qualify with a soft credit inquiry, which doesn't affect your credit score, to see what loan terms you might qualify for. Pre-qualifying is a great way to gauge eligibility. For instance, Brian filled out a pre-qualification form online with a lender, inputting his income, credit score range, and desired amount. Within minutes, the lender showed him an offer he would likely get if he formally applied, all without a hard credit pull. This gave Brian confidence about his chances and the rate he could get before he proceeded to the official application. Take advantage of pre-qualification tools to check your eligibility and rate range up front. A personal loan is just one form of financing. A smart borrower asks, is a personal loan my best option, or are there alternatives? Depending on your needs, another product might save you money. For example, if you need to borrow a small amount for a very short term, a credit card, especially one with a 0% introductory APR offer, could be cheaper, provided you can pay it off quickly. If you have equity in your home and need a large amount, a home equity loan or line of credit might offer a lower rate, since it's secured by your house. For students or education costs, a student loan would be more appropriate than a personal loan, usually. Consider the specific purpose of your funding. Some alternatives to personal loans include balance transfer credit cards or low-interest credit cards, useful for short-term needs or debt consolidation if you can pay off within a promotional period, e.g., transferring credit card debt to a 0% APR card for 12 months. Home equity loans/HELOCs, good for home renovations or larger expenses if you're a homeowner. They often have lower rates, but your home is collateral. Personal line of credit, more flexible than a loan if you're not sure exactly how much you'll need. You can borrow as you go. If your expense is unpredictable, a line of credit might be safer. 401k loan or borrowing from life insurance. These tap your own assets. They have their own pros, cons, and risks, so tread carefully and perhaps consult a financial advisor. Borrowing from family friends. Not a product, but an option some consider. Just be sure to treat it like a real loan with clear terms to avoid misunderstandings. Also, think creatively. Do you really need to borrow, or can you adjust your budget or timeline? For instance, maybe you can delay that non-urgent home project and save up cash, avoiding debt altogether. Or maybe you can sell an asset or pick up extra income to cover the expense. In short, don't assume a personal loan is the only or best way. Check interest rates and terms on alternatives. Sometimes, it absolutely is the right tool. Personal loans are great for consolidating higher interest debts or making a large purchase manageable with fixed payments. Just make sure you've considered the alternatives so you feel confident a personal loan is the optimal choice for your situation. Not all loans or lenders are created equal. Banks, credit unions, and online lenders can offer very different interest rates, fees, and experiences. It pays to shop around and compare. In fact, one of the biggest mistakes people make is taking the first offer they get without exploring others. Personal loan rates can vary widely between lenders, sometimes by several percentage points for the exact same borrower. So, compare at least a few options: your bank, a local credit union, and some online lenders or lending marketplaces. Banks. Traditional banks often prefer customers with good credit and stable income. If you have an existing relationship, like a checking account, your bank may offer a slight discount or make the process easier. Some big banks offer personal loans with competitive rates for well-qualified borrowers. However, banks might have stricter credit requirements on average, and not all big banks even offer personal loans. Credit unions. Credit unions are nonprofit member-owned institutions. They often offer lower interest rates and flexible terms for their members, especially for those with fair or average credit. Credit unions often beat banks on rates for personal loans. For example, if a bank offers 12% APR, a credit union might offer 9 to 10% to the same borrower. The catch is, you need to be a member, but membership criteria are often easy, sometimes as simple as living in a certain area or a small donation to a partner charity. It's definitely worth checking credit union options. They may offer more favorable terms than traditional banks. Online lenders, financial technology, fintech. Companies and online lending platforms have become very popular. They often provide fast approvals, user-friendly apps, and will pre-qualify you quickly. Many online lenders cater to a range of credit profiles. Some specialize in excellent credit, offering very low rates to top-tier borrowers, while others specialize in loans for people with lower credit, charging higher rates but offering an option when banks won't. The convenience is high. You can often complete the whole process from your phone, but keep an eye on the rates. As a general trend, online lenders' rates can be a bit higher on average than banks charge credit unions for those with good credit, but for those with lower credit, they might be more willing to lend at a cost. Marketplace lenders, websites like LendingTree, Credit Karma, or Bankrate's Loan Marketplace allow you to fill one form and get quotes from multiple lenders. These can be great to compare offers side by side. Just be prepared for possible follow-up contacts from lenders. When comparing lenders, look at the APR, annual percentage rate, of each offer, because APR incorporates not just the interest rate, but also any upfront fees, giving you a true apples-to-apples comparison of cost. Also consider the lender's reputation and customer service. Since you'll be dealing with them through the life of the loan, you want a company that is transparent and responsive. Real-world scenario. Jen needed a personal loan for moving expenses. She first checked an online lender that advertised quick funding. They offered 11% APR. Her local credit union, where she's been a member, offered 8.5% APR for the same loan amount, and an online marketplace showed another lender willing to do 9.5% with no origination fee. By comparing, Jen clearly saw the credit union was cheapest. The difference of a few percentage points saved her hundreds of dollars in interest. The lesson? Spend a little time to shop around. It can pay off significantly. Tip: when rate shopping, try to submit your applications or requests for quotes within a short window, usually 2 weeks or so. Credit bureaus generally count multiple inquiries in a 14 to 45-day period as one inquiry for scoring purposes when you're clearly shopping for a loan. This means you can check with several lenders without hurting your credit each time, as long as you cluster the applications. Alternatively, use pre-qualifications, soft pulls, to compare offers whenever possible. The interest rate is basically the price of borrowing money, the percentage of the loan amount that you'll pay in interest charges each year. The APR, annual percentage rate, is a broader measure that includes the interest rate plus any fees, like origination fees, to tell you the total annual cost of the loan. When you're evaluating loan offers, pay attention to the APR, as it gives a more complete picture of cost. For instance, a loan with a 10% interest rate and no fees will have a 10% APR, but a loan with a 9% interest rate that charges a hefty origination fee might have an APR closer to 11 to 12%. Always compare APR to APR across loans, so you're not misled by a low advertised interest rate that hides high fees. Now, what rate should you expect? That depends largely on your creditworthiness and the market conditions. As of mid-2025, the average personal loan interest rate is around 12.6% for borrowers with decent credit. Borrowers with excellent credit can do much better. Some lenders offer rates in the mid-single digits, around 6 to 8%, for top-tier applicants. On the flip side, if you have poor credit, you might see offers with APRs in the high teens or even 20% plus range. Your job is to secure the lowest rate possible for your situation. This is where shopping around and improving your credit come into play. Even a difference of a few percentage points makes a big difference in what you pay over time. For example, a $10,000 loan at 8% over 5 years will cost about $2,166 in total interest, whereas the same loan at 12% would cost about $3,347 in interest. That's over $1,100 extra paid just for having a higher rate. Keep in mind other factors that can affect your rate: loan term, Some lenders have different rate tiers for different term lengths, loan amount, and whether you set up auto pay. Some lenders give a small discount, e.g., 0.25% for auto pay enrollment. Make sure to ask about any such discounts. Key takeaway: know both the interest rate and APR of any loan you consider. Aim for the lowest APR. If an offer's APR seems high and you have time, you might hold off and try to improve your credit or apply with a cosigner. Always ask the lender if the rate is the best they can do. It never hurts to inquire if you qualify for any reductions or if there are rate discounts for loyalty or other products. When discussing interest rates, clarify whether the rate is fixed or variable. This affects the stability of your payments. A fixed-rate personal loan means the interest rate stays the same for the life of the loan. Your monthly payment is locked in and won't change. This is the most common type of personal loan in the US, and it's generally preferable for most borrowers because it provides certainty. You can budget the same payment every month, and you know the loan will be fully paid off after X years if you make all payments. A variable rate or adjustable rate personal loan means the interest rate can change over time, usually in relation to a benchmark, like the prime rate. Variable rate loans might start with a lower initial rate, but beware. If interest rates in the broader market rise, your loan's rate and payment could increase. Personal loans with variable rates are less common. You see variable rates more often with lines of credit or certain student loans, but if you are considering one, ask how often the rate can change and what the rate cap is, if any. If you cannot pay off the loan before the rate adjusts, you could end up owing more interest than you planned. Real-world scenario: Mark was offered a $20,000 loan with a 5% introductory variable rate, whereas a fixed-rate option was 7%. The 5% variable sounded great, but on reading the fine print, Mark saw that after 12 months, the rate could adjust quarterly. Given that interest rates were generally rising, he realized that 5% could climb to 8% or higher in a couple of years, making it potentially more expensive in the long run. Mark chose the 7% fixed loan for peace of mind, knowing his payment would remain the same. For most personal loan borrowers, a fixed rate is the safer bet. You might consider variable only if you plan to pay the loan off very quickly, before any rate changes can happen, or if the lender's rate caps are low and you understand the risks. Always ask and understand, is my rate fixed or variable? If variable, what's the current rate, how is it determined, and how high could it go? Loan terms refers to all the key details of the loan: the term length, how long you have to repay, the repayment schedule, and any fees or conditions. You want to get the friendliest terms possible. Here are some specifics to check. Term length. Personal loan terms can range from short, 12 months, to long, 5 to 7 years, sometimes more. A longer term means smaller monthly payments, but you pay more interest overall. A shorter term means higher monthly payments, but less interest in total. Find a balanced term that you can afford monthly, but isn't excessively long. Always look at the total cost over the life of the loan, not just the monthly payment. For example, a 3-year loan will save you a lot in interest compared to a 6-year loan if you can manage the higher payments. Don't get monthly payment tunnel vision and ignore how much extra interest a longer term will cost. Origination fee. Many personal loans charge an upfront origination fee, often around 1 to 8% of the loan amount. This fee is usually deducted from your loan funds, so if you borrow $10,000 with a 5% origination fee, you'd actually receive $9,500, but you still have to repay the full $10,000. Check if the lender charges an origination fee and factor that into your cost. Some lenders have zero origination fee, which is great. Others might charge it but perhaps offer a lower rate that still makes the deal worthwhile. It's the APR that will tell you the full story. Prepayment penalty. Ask if there's a prepayment penalty for paying off the loan early. A prepayment penalty is an extra fee charged if you pay down the loan ahead of schedule. Many personal loans do not have prepayment penalties. They allow you to pay early and save on interest. But a few do. Obviously, a loan without a penalty is better, since it gives you flexibility to make extra payments or refinance later. If a loan does have a prepayment penalty, be very cautious. It can reduce your ability to save money by paying early. Late fees and other fees. Understand the fee for late payments, and try to avoid ever needing to pay it by setting up autopay or reminders. Late fees might be a flat amount or percentage. Also see if there's an application fee. Most personal loans don't have this, aside from origination, or an annual fee, rare for loans, but some lines of credit have maintenance fees. Essentially, read the fine print and know all the potential charges. Personal loans should be fairly straightforward, mainly interest and possibly origination, but you don't want surprises like a fee for processing payments or such. Total cost disclosure. Lenders are required to disclose the total cost of the loan, principal plus total interest plus fees, in your loan agreement. Make sure you review that number. Sometimes seeing the total dollars you'll pay back, e.g., you will pay back a total of $11,200 on this $10,000 loan, can put the loan in perspective and help you make a better decision. In summary, ask about every term and condition. How long is the loan? What is the monthly payment? When is it due each month? Is there an auto-pay discount? What fees will I pay, upfront and over time? You want the loan with the best combination of low rate, appropriate term length, and minimal fees. And of course, ensure you borrow only what you need and have a plan to abide by these terms. Getting your loan application checklist ready in advance will make the process smoother. While each lender's process can vary, generally you'll need to provide documentation to verify the information on your application. Here's a quick checklist of common documents and info to prepare. Personal identification. Government-issued ID, such as a driver's license or passport, to verify your identity. Proof of address, recent utility bill, lease agreement, or other official mail that shows your name and address. Proof of income. This can include pay stubs, W-2 forms, tax returns, or bank statements. Lenders want to see your income to ensure you can pay the loan. If you're self-employed, tax returns and bank statements are usually required. Employer and income details. You'll need to provide your employer's name, your position, and how long you've worked there. Some lenders may do a verbal or written verification of employment. Debt information. While your credit report will show your debts, be prepared to answer if you have other obligations like rent, alimony, etc., and your monthly payment amounts. Loan purpose. Some applications ask for a brief description of what you'll use the loan for: debt consolidation, home improvement, etc. This usually doesn't require documentation, just a stated purpose. If you have these items ready, you can respond quickly to any lender requests. After you apply, the lender might come back with requests for additional documents. For instance, if something on your pay stub is unclear, they might ask for a bank statement. Or if you're consolidating debt, they might want account statements for those debts to pay them off directly. Responding quickly to these requests will speed up your approval. Most loans these days, especially online, can be done electronically. You'll upload documents or take photos of them. Many lenders can approve a loan within a day or two of receiving all your info, sometimes even the same day. Once approved, funding can be fast. Often you'll get the money in your bank account within a day or a few business days. One more tip. Pre-qualification, as mentioned earlier, is often the first step. Use it to your advantage. Pre-qualifying, soft credit pull, will tell you if you're likely to be approved and at what approximate terms before you commit and trigger a hard inquiry. After that, you proceed to the formal application and submit documents. During the formal application, answer all questions honestly and completely. Misstating information, like inflating income, can not only lead to denial, but could be considered loan fraud. By preparing this application checklist beforehand, you'll make the process far less stressful. You'll also demonstrate to the lender that you're an organized and credible borrower, which can only help your chances. We've woven in many tips on what to do. Now let's recap what not to do. The common mistakes people make when applying for a personal loan, so you can avoid them. Not checking your credit. First, don't apply blindly without knowing your credit score and report. This is like flying in the dark. Checking your credit first lets you spot issues and gauge what offers you might get. It also prevents surprises. For example, finding out during the application that your score was lower than you thought. Always check and, if possible, improve your score before applying. Even a modest boost can secure you a lower rate, which saves money. Applying to every lender under the sun. While shopping around is encouraged, do it strategically. A mistake is applying to multiple lenders over an extended period thinking one is bound to approve you. This can result in multiple hard inquiries that drag down your score. Instead, shop in a focused time frame, 2 weeks or so credit bureaus treat it as rate shopping and it won't hurt you as much. Better yet, use pre-qualification tools to narrow down prospects without impacting your credit. Not shopping around at all. The opposite mistake is taking the first loan offer you get. Lenders have different rates and fee structures. Not comparing could cost you dearly. Even if you have good credit, one lender might offer 10% while another offers 7% for the same borrower. Always compare at least a few quotes. Remember, personal loan interest rates can vary by several points between lenders, and some lenders, like credit unions, might give you a significantly better deal. Borrowing more than you need. We discussed this, but it's worth emphasizing. Don't automatically take the maximum you're approved for if it exceeds your actual need. It's not free money. You'll pay it back with interest. Only borrow what you absolutely need and have a plan for. Focusing only on monthly payment. A very common pitfall is to fixate on, can I afford the monthly payment, and ignore the loan term and total cost. A lower monthly payment is not always better if it comes from doubling the loan term. You could pay thousands more in interest. Consider both the monthly affordability and the total cost over time. Sometimes it's wiser to tighten your belt with a slightly higher payment for a shorter period and save a lot in interest. Ignoring the fine print, fees and conditions. Always read the loan agreement and understand fees and conditions. Origination fees, late fees, prepayment penalties, know them up front. If something is unclear, ask the lender. Don't assume there are no fees. For example, you don't want to be surprised by a 5% origination fee deducted from your funds or a penalty for early payoff because you skipped the fine print. Know what you're signing. Using a personal loan for the wrong reasons. As discussed, a mistake is using personal loan funds for non-essential or financially unwise purposes, lavish weddings, luxury gadgets, etc., especially if it puts you in long-term debt. It's your money ultimately, but be mindful that you'll be repaying with interest. If the purchase doesn't provide lasting value or could be saved up for, reconsider taking a loan for it. Not having a repayment plan. Don't take a loan assuming I'll figure out how to pay it back later. You should already know where the monthly payment will come from in your budget and have a plan if things get tight. Also, plan to pay the loan off on schedule or early if possible. If you just make minimum payments and don't plan ahead, you risk missing payments if unexpected expenses arise. Have an emergency fund or some buffer so that a single hiccup won't cause you to default. Being disciplined with repayment is key to reaping the benefits of a personal loan, like improving your credit or achieving your goal, without falling into financial trouble. Avoiding these mistakes will put you in a stronger position. Essentially, be an informed and proactive borrower. Check your credit, shop around, borrow cautiously, read everything, and plan your payoff strategy. A personal loan can be a powerful financial tool. It can consolidate high-interest debts, cover an important purchase, or help you handle an emergency with manageable payments. But the key is to go in with eyes open and a solid game plan. By following this personal loan checklist and asking these top questions before applying, you're empowering yourself to make the best decision. You now know what to know before getting a personal loan, from understanding APR and interest rates, to comparing lenders, to avoiding common pitfalls. Before we wrap up, let's quickly recap. Always clarify why you're borrowing and borrow only what you need. Make sure the monthly payment fits your budget with a cushion, and get your credit in the best shape to score a low rate. Explore your options and shop around for the best offer. Don't settle for the first loan you see. Understand every term and fee in the loan agreement, from the interest rate, and whether it's fixed or variable, to any origination or prepayment fees, and have your documents and repayment plan ready to go. By doing your homework up front, you can avoid costly mistakes and debt stress down the road. We hope this overview has armed you with the knowledge and confidence to navigate the personal loan process like a pro. Taking on debt is a big decision, but with the right questions and careful planning, a personal loan can be a positive step toward your financial goals. Thank you for watching, and best of luck with your financial journey. If you found this helpful, please give it a thumbs up and subscribe for more insights. Now, go forth and make smart financial choices.